Hello, this is Tommy from the Foxtrot Group, and today we want to share with you our analysis of Fortifying Fortis. Ultimately, this is a discussion about how to maintain a company's resilience and flexibility in a finicky industry while also providing opportunities for growth. This is a tough decision, and we need to have a strong understanding of what considerations came into play when Fortis, a large energy distribution and generation company, considered the opportunity to acquire an energy distribution firm. Before we get into the nuts and bolts of this decision, we need to better understand what Fortis is and what their strategic alignment looks like. Fortis's corporate strategy was to continually invest in the power generation and distribution space, but in such a way that no more than a quarter of the company was exposed to a single regulator. Regulation is an unavoidable, unpredictable, and possibly large disruptive risk to the company, and diversification reduced the impact that any one agency could have on the overall business. This strategy forced the company to make acquisitions across regions instead of focusing on single areas of the world. After having tried to diversify their overall holdings into other sectors like hotels, finance companies, and partnerships with companies like AT&T, the company decided to divest from those holdings and focus on the energy sector. In so doing, they needed to make sure that their diversification in terms of regulatory agencies was achieved. And they made strategic investments in South America, Canada, and the United States, all in an effort to increase their business year over year while continuing to minimize their regulatory exposure. The good news is that Fortis has a proven track record of acquisitions. They have managed their subsidiaries well and have enjoyed a history of steady growth based on the discipline that Fortis has been able to acquire these new firms. In the past few years, Fortis has been able to increase their asset base by hundreds of billions of dollars in the areas of electricity generation, such as power plants, as well as long-range energy distribution. In late 2015, Fortis was considering the purchase of a company called ITC. Let's talk about ITC more for a moment.
ITC's business strategy is essentially to wholesale electricity to local distribution companies across the Midwest, operating under 3 different subsidiaries across Iowa, Michigan, Minnesota, Illinois, Missouri, Kansas, and Oklahoma. They specialize in the transmission of electricity from power generation companies to local distribution companies across their network of long-distance, high-voltage power lines. ITC had continually delivered increased earnings per share, increasing from $1.49 per share in 2013 to $1.57 per share in 2015. They also held assets to the tune of $7.4 billion at this time. So, how do we evaluate this ITC opportunity? ITC was in a space in which Fortis had no experience. While Fortis was well positioned upstream on the electricity value chain as a supplier and distributor, Fortis had not yet operated as a transmitter directly to customer homes and businesses. We will get into the cost and risk consideration in a moment, but this fact that ITC offered something completely new to Fortis' portfolio is an important consideration, and it's reasonable to understand why there was concern about this potential step.
Hello, I'm John Crow, and I want to talk about this decision to, either ally or acquire or ignore the ITC opportunity. Fortis has both the power generation and the power distribution experience under their portfolio of current companies that they operate. Because of this, they offer an experiential advantage for the companies that they partner with or choose to acquire. More importantly, there is a real advantage to the economies of scope and the laissez-faire management style that Fortis chooses to give its subsidiaries. Most of their acquisitions were able to operate on their own with minimal reporting requirements, while taking advantage of Fortis' ability to be able to leverage their larger enterprise tool sets as part of being counted as a member of this larger portfolio. In addition, Fortis offered protection and guidance to each subsidiary and the subsidiary's board by placing their executives on each board in a strategic fashion. This gave Fortis the ability to provide strategic direction from above, but also go to bat for the company in the event that it was needed. They also had senior leaders of each subsidiary meet regularly to discuss common topics and provide cross-subsidiary guidance. Ultimately, Fortis provided high-level direction to any subsidiary that was added to their portfolio, giving each one much more strategic direction than they would have operating independently. All in all, if an acquisition should occur, it is a reasonable assumption that the disruption costs would be kept to a minimum, and the best practices that Fortis has developed over billions of dollars worth of acquisitions will be applied in the case of an ITC merger. On the other hand, Fortis could pursue a partnership with ITC instead of acquisition. This would eliminate the debt incurred by Fortis as part of the acquisition, totaling about $6.4 billion. However, this would force Fortis to work with ITC to ensure that the partnership would end up being a success and foregoing the acquisition altogether. While this would be a much less capital-intensive exercise for Fortis, it would also go against the current market trends of consolidation. As the case study points out, utilities in the United States, for example, have gone from over 100 independently owned utilities to less than 40 in the past decade. From a broader perspective, there simply aren't a lot of tangible benefits that an alliance could offer Fortis. ITC's market is not in the same geographic location as Fortis, so there are very little opportunities for customer-focused economies of scale. Because of the high capital investiture needed, there would be little value from Fortis's participation for soft skill transfers via an alliance, and alliance does not protect Fortis from its current competition. Circling back to the acquisition routes, by acquiring ITC, Fortis creates a vertically integrated generation, transmission, and distribution company that can create strategic direction at the board level across all subsidiaries. This gives them the ability to stay competitive across all facets of the electrical industry and ultimately move them further forward towards their goal of 25% of the company being exposed to a single regulator. By acquiring a power transmission company, Fortis adds another regulator to their portfolio and further diversifies their portfolio. While they take on incremental debt as part of the acquisition, both from ITC and for the cash required to complete the deal, they are in line to emerge as a much stronger, vertically integrated company as part of the deal. Fortis gains competitive parity with other distributors as the market continues to consolidate and the bargaining power of more integrated firms increases. So the acquisition looks like a strong option, but how do we evaluate whether or not that acquisition is worth what it would cost in terms of dollars, sweat, and time?
There are two important considerations for the valuation of the potential ITC acquisition. First, we would use a framework to make sure that there are demonstrably significant gains to the term of synergies, resources, and market conditions that would make an acquisition favorable. When we apply this when to alley and when to acquire model, we can see that there are significant capital requirements to enter a market and to realize any synergies between two companies. The shrinking American generation and distribution markets also point favorably towards acquisition, plus a few more factors that we will get to in a few more slides. Just because the conditions are favorable, it doesn't mean that the ITC opportunity is a good deal. Second, we need to determine if the actual price that Fortis must pay to acquire ITC is worth the opportunity cost. Unfortunately, since the regulatory and competitive landscape of energy distribution and transmission industries are very different from place to place, a comparable analysis would be most useful analysis. By comparing the relative ratios such as PE and EV, a similarly sized distribution is similarly regulated markets. The peer group comparable will serve as more a useful benchmark of ITC performance. Fortis does not have any expertise in distribution, so a comparable analysis will provide better context to evaluate the desirability of this merger. This is unfortunate because the case as presented did not provide enough information to conduct this type of analysis. Instead, we conducted a simpler dividend discount model. Using the DDM, we calculated the market capitalization of Fortis to be about $27.1 billion. If you want more details about these calculations we performed, the spreadsheet can be provided upon request. The combined market capitalization of Fortis and ITC as independent companies is $37.6 billion. ITC market capitalization is stated as $10.5 billion. With this valuation, we can inu a reasoning offering for this acquisition. The offering price of $12 billion, which can be a combination of cash, debt, and common stock offerings, is a reasonable offer with a 15% premium for the acquisition. As we said earlier, this is a low risk to Fortis and the deal acquisition is not accomplished. The strategy is to diversify Fortis's regulatory risk, but it doesn't make sense to chase this acquisition and pay too high for a premium for it. More opportunities may come. There is no indication that other firms are looking to acquire ITC, and even if another firm did require ITC, the risk to Fortis is minimal. With this in mind, a $12.75 billion walkaway price is reasonable. 12.75 billion would be a premium of less than 22%, which towards the higher end of the premiums typically paid in the industry, but they are justifiable. Above this point, Fortis should consider other options.
At the end of the day, Fortis's management must believe that this is the best move for the company. The decision boils down to the core goal of mitigating regulatory risks. Having an energy transmitter like ITC will protect Fortis's shareholder interest over time. The long-term demand forecast for energy distribution and generation, Fortis's bread and butter, are decreasing by 2% each year. The market is contracting and perhaps pivoting towards a more integrated model that is driving out the need for long-range transmissions in North America. Transmission has a brighter outlook due to the increased demand in locally generated green energy, and this segment might be resistant to conditions that cause other segments to struggle. Meanwhile, the timing of this acquisition is favorable because the premium of ITC has dropped recently. This provides opportunities for Fortis to bring to bear its greatest chances for synergy. Fortis can provide guidance to ITC to continue growth, diversify its risks, and create a foothold for more opportunities in the future. In light of all of this, it makes sense to fortify Fortis's current position with a bid to acquire ITC.